Yeah, hi everybody. Tom Williams here, speaking to you from Worthing, Sussex, England. Good day to you all. What we've got up now is an hour chart of the S&P 500. This is the future though. Remember, the future is a derivative of the cash. What the cash does, the future has to follow, and that's because they've got a small band of traders skilled in arbitraging, where if it gets out of the line, they buy one and sell the other. It's beyond our reach because they have to do thousands of contracts apparently to make any money on that. But they do, obviously, but it keeps it in line. Now, right, so we will close Monday. So there's only Tuesday, Wednesday, Thursday, 4 days, right? Anyway, we've got an hour chart up of the S&P future. Now, there's no special reason why I've got the hour up, because you could look at any of these charts. But the reason we can see clearly why it's gone up there, because this looks like a shakeout here. This is a shakeout. Whenever you see this, whenever you see these markets move sideways like this, you expect a test. And if you don't get a test, you do nothing. But we're expecting one. There's an upthrust there to mark the factors that they're going to mark it down. And there's the markdown. That's really, I think Wyckoff called a springboard. But I'm beginning to call that now, well, I've always called that a shakeout, which it is. They plummet it down, look, knowing too well that they want to take it up. Right, the volume is high. It's probably the opening of the S&P pit anyway. It's closed in the middle, and that's why it's gone up. Whenever you see that like that, you will expect higher prices. It's unusual if you don't. So on the back of that, up it goes. The volume is high, but that's all right. In this area, because you've got this shakeout behind you, and then as it pushes up through these old tops, look, this is what we call absorption volume. That high volume there represents the professional money prepared to absorb locked-in traders that are selling around here, which they do. Remember, there are not hundreds, but there are thousands of traders in these markets, and a lot of them will be locked in on these fairly high bits here as you get these shakeouts like this. Now, professional money are not really, they don't want to buy off these people, right? They want to buy at these lower prices here. That's why they have a shakeout, trigger all the stops. So they know how human behaviors will behave under certain circumstances. So they know people are sitting there, lots of traders are sitting there thinking, right, I'm getting out of here. I don't like the look of this after this shakeout like this. They know that's going to happen, so they have a widespread outlook as they push up rapidly as possible through these old highs. And that high volume could represent a absorption of any supply if they're bullish. Now, it's coming off, you would expect a test of some sort. This is now a chart. You would expect a test if that was a genuine, which it looks like, a genuine attempt to take this market up higher. Although it's coming off here. Right, I think we better look at a different time frame now, Peter. Yeah, 20 minutes or something.
John is saying arbitrage. What is the effect on VSA principles?
None. Do you want to repeat? Hang on.
Yeah, hi. John is saying arbitrage. What is the effect on VSA principles?
Well, I say there's little or none, because that's what we're following. We're following the action of professional traders. And all arbitraging does, well, it's a massive thing, all I say all it's doing, but what it does, it makes sure that the future runs in line with the cash market. The cash market is where the equity lies, where the value lies. The future is a derivative of that. And if it ever gets out of line, taking account of trading and the cost of doing the trade, one thing or another, but they will do it. I know there's a small band of traders that walk around the floors of these major areas in New York, Chicago, wherever they are, and that's all they're looking for is arbitraging. It's successful. The only thing is they have to trade in large numbers. All it does, it keeps the future in line with the cash market. Now, of course, that's all open to abuse and confusion, because I've heard these TV programs saying, oh yeah, well, the market shot up, it was driven by the future. Well, that's a load of rubbish, really, because the future, don't forget, the people that are trading the cash market also obviously trade the future. And they know perfectly well that certain actions within the cash market will, say, take it up. Therefore, they know the future has to go up. So it's pretty obvious that they will trade that as well. And that would make the future appear to move rapidly, almost before the cash. But believe me, I know these traders exist, and they call them arbitrage traders. But as far as we're concerned, it doesn't make any difference. It all happens so fast. The principles will be embedded within the chart of their actions. Now, what we were saying now, we were saying that this is probably, well, there's a shakeout here, right? That will be hopefully absorption volume, but you would expect that to be tested. Right now, we know we can't see any serious high volume on any of these up bars. So there's no reason really why that index should come off like that, other than it's testing this volume here. If this volume remains low, or even lower than that, I'd like to see, then you assume that this high volume here, which represents supply, has not really disappeared. But if this volume, or a further down bar, or another bar somewhere along here, where the volume is obviously low, less than this, a lot less, then that's going to move it up. Are there any questions about that? Type them in. Rita's got her eyes glued on the screen.
I've got a question from Robert. Tom, could it be a false breakout on the S&P 500 now? What time frame are you looking at, Robert? $20-minute. 20-minute, yes. Could it be a false breakout?
Put that daily chart back up. No, it's not a false breakout. If it's false, then usually it collapses much faster than this bar here. It's usually 1 or 2 bars and off it comes. Although this looks a bit terrifying, especially if you're in a trade there somewhere. But this is highly unlikely to be a false breakout because you've got this shakeout here. And also the daily chart looks as if it's trying to go up, still trying to make new highs. Now we're back down to this level look here. If this volume remains low now, then that index is going to go up. Or good chance it'll go up. Well, I say it will go up. Put the daily chart up, Peter, please. Now, what's this, the S&P? Now, this is the S&P daily chart. This is where the equity lies. Sorry, folks, phone's gone. Very disruptive. Anyway, I think we looked at this before. It's unusual if these lows aren't caught. Right. And then there's a test, look. And up it goes. It's now hit that top trend line. The volume's fallen off. There, look. And that's why that signal's come up. No demand. Yes. What there? What's that signaling? Weakness. Well, that's the volume's average. And it would be weakness because it's now overbought, which makes the market vulnerable. Now, what's interesting here, there's definitely some sort of weakness supply there. Now, I've mentioned this many, many times, especially recently, that if they test that, then you expect the market to go up. And next day, that will be Wednesday, wouldn't it? Lo and behold, look, there's a form of test. We know that if you see a red down bar, what we'd like to see is a narrow spread close in the middle and the volume less than the previous two, in other words, low. But let's see what the computer's reading it as. So if you look down here, it tells you, look, right, we know the bar's down. We can see the volume is average, but the spread is narrow. Don't forget it's volume spread analysis. And it closed in the middle. So that's really a test. That is a test of that weakness on that previous bar, look. That's why it went up next day, look, or next bar. That is a test. Bang, hit that trend line, look, or found a bit of support. Trend lines will do that. If you break up through the trend line and it comes back down, it's liable. The trend line that was supply here is now become support. Right, so up it goes. I think it's now telling us that I'd say there's no demand. There's not a lot of demand, but there's not a lot of supply there. It's only just, the volume has just fallen off below the average line, look. So there's nothing too dramatic here that we could scream out and say this is happening or that's happening. But that is a test, look. That is a test of that weak bar there, right? And the volume is low, the spread is narrow, it's close in the middle. The only slightly negative thing about it is that a nice test doesn't have a top tail. Anything that sticks up above the close of the previous bar must represent a little bit of weakness, but there's not a lot there. But there's enough to drive that market up the next bar. So that was Thursday, yesterday. Now, is there any questions about that particular little bit? You can see it's still trying to trend up here. Don't forget, these markets will climax at some time. A buying climax is you'll see a rapid move up. The spreads, climactic action is usually wide, closing in the middle. Volume will be massive. When you see that, that's what we call a buying climax. The other top, of course, is a signal called the end of a rising market. And that will probably gap up into new high ground on some good news. The spread will be narrow and the volume massive. If you see that, that's almost 100% guarantee that's a market top after you've seen a bull move like this that's been going on for some time. So that's a daily chart. Any questions? No questions on that. Okay. Put up the Dow or something. Okay.
A question from Jerry. Would you expect that last bar to be tested again, since the volume on the last test bar was not that low?
Well, the thing is, it's all very well saying, will you expect that? I suppose you would, but if you sit there expecting something, you can bet your bottom dollar it won't happen. It's the way the market is so cunning and devious. It's the way it seems to work. But what you do is that when you do see a test, then you recognize it. But you've got to be very careful. It's very negative, really, to say, I'm going to expect a test. But what you do know is that if you do see a test, then you know that's going to go up on the next bar, at least. And it usually happens after you see the sign of weakness. Like here, look. That would indicate very clearly, I think I mentioned this many, many times recently, we see it in all sorts of charts, stock charts, currencies, all sorts of different vehicles. We see that happening. It's obviously a very common way of trading this, professional money. The market works on supply and demand. If there's supply there, right, that stops the up move for the time being. But if it's tested the very next bar and there's no supply, that's why it went up. Now, very few people in the world know that. So hopefully you could sit there with a grin on your face and you know something not many other people know. And that's why I very rarely bother to talk to people about these markets, because they don't know what on earth you're talking about. They probably think you've got a screw loose anyway. And I mean, I've heard people say, oh, you can't possibly tell anything about the market because you don't know if the news is going to be good or bad. I mean, you might say, oh, it's going to be bullish, and suddenly bad news comes out. So it's no good talking to people about it. You have to read these charts knowing full well that it does work on supply and demand. And you can read it. Of course, in hindsight, I realize that it's much, much easier, obviously, because it's all laid out for you. But you can see we're overbought now. We can see the market still trying to trend up. But traditionally, for the last several hundred years, these markets keep moving up until they climax. They have a buying climax. And that means professional money are unloading sufficient amounts to make that market weak. But even when that happens, it still has to go sideways, and they will whipsaw it up and down to your disillusionment or amazement how it can do that, but it will do that. And that's why they have what we call upthrusts and no demand just before any serious down move. It's all designed for you to lose money.
Edmund also says this is a perfect chart to talk about the simple trending system as well. Right. Oh, you're speaking.
Well, the trending system, I mean, I've told you the story before. You know, I spent 6, 7, even 9 months studying for a trending system. I put a lot of thought, careful thought into it, and I had availability of a programmer who was very good, could do it. And at the end, it wasn't bad, the trending system. But the problem was that you'd get a major turn, and the system that was designed just didn't pick it up. It picked a lot of them up, but not all of them. And of course, you can't have that. It's 100% misleading when that happens. But I was sort of lying in bed, and I realized that the easiest way, which I knew what they did, that once professional money had taken an index or stock or whatever it is up, then what they do, they make sure that the close of the bar is higher than the close of the previous bar. And that, because their big worry is that other professionals don't come in and start selling into their buying. That's what they don't like. And so what we do, we say, okay, if that's the way you do it, we color all the bars blue, that where the close is higher than the close of the previous bar, right? Allow for one down bar, ignore level bars. So we let the computer loose, and bang, it seemed to work. Up, up, allow for one down bar, up, 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 allow for one down bar, up. So it's actually trending up. And that's why I call it a simple trending system, because it's non-complicated. Anybody can really see the logic behind that. There's nothing clever. You don't have to be a genius to figure that out. But I went the hard route and then realized I was wasting my time, because it was a much easier route. And if you look at a weekly chart or monthly of this S&P, you'll see the trading system still works. It's been going on for weeks and weeks, even months, which again, not many people seem to have noticed. Professional money must know, because they do it. I mean, we used to do it, I remember. Once you're in a move and you've got hold of a bullish move, the main worry that you've got is that other professionals are going to start dumping supply into your buying. That's the main worry. However, they won't do that if they think the thing is still bullish. They keep moving up persistently. The close is higher than the close of the previous bar. So that seems to work, and that's really a good hand holder. So if you ever go long and you want to stay in the position for as reasonable length as possible, see, it's very easy to get shaken out of a good trade. You know, you spend all this time and suddenly you catch a decent, really good trade, and then you sell too soon. And then in hindsight, I've had people ring me up, say, whoa, yeah, Tom, I picked the bottom. Yeah, that was fine. But then I sold out too soon, look. And that's what happens. But that's simple trading system is a hell of a hand holder. It's a terrific guide for you. So you allow for one down bar, ignore the level bars, and all the time that close is higher than the close of the previous bar, it must basically still be marked up or bullish by the people behind that move.
On that subject, Jerry is asking, what is the reason for the one down bar in an uptrend? Is it simply a test?
Usually, yeah, it's just a test. Or perhaps they try to catch a few stops. Or we don't ask too many questions because you'll never hear the truth anyway. Even if you had contact with several of these top professionals actually active, they would probably lie to you anyway. Well, I'm sure they would. I mean, why should they tell you anything? Or anybody else? But the one down bar is just their security blanket, I suppose. They want to see if there's any supply there. But if you check that trading system out, that simple trading system, I think you'll find I'm not far all that out from it.
Okay, Eleni has asked feeder cattle and lean hogs if time permits. But this one, Tom, is feeder cattle. Do you want to adjust that?
No. You say it's just feeder cattle?
Yes.
Now, I don't know, this data doesn't look right to me, does it? I mean, it's quite a heavily traded contract, cattle feeder.
Emily, does it look right?
Does this chart look right, Emily? It certainly looks if it's run, I mean, this here looks seriously weak there.
Potential buying climate. Yeah, Eleni saying it is correct, this chart.
Yes, right. There's definitely not a lot. They're marking it up, look. That seriously looks weak to me. And you'd be really pushing your luck if you were long on that. Especially you see when you have these up moves like this, big ones, all right, the market becomes vulnerable. And what we mean by that is that professional money who are in there with thousands of contracts, right, know that their time has probably run out and they want to start selling. So they have to mark it up on good news, hold the market up, even have these up moves after you've seen weakness. Look, there's weakness and there's more weakness here. So that, to me, begins to look very, very weak.
Emily says she's waiting to short.
Yes, that's very good. They'll probably, we did trade feeder cattle once for the upside and that was quite successful, but I'm not quite sure about this shorting. I'm not an expert in this area on this particular contract, but certainly I'd rather be short than long, that's for sure. And I think waiting for the right position is the right thing to do. What was the other one?
Lean hogs.
Lean hogs. In England, we don't call them hogs, do we? We call them pigs. Swine, pigs, whatever. But anyway, it's a wonderful name, hogs, isn't it? But this looks awfully weak, doesn't it? I mean, look at that upthrust there. But see, this is why these markets are so treacherous. You know, this huge gapping up. You can see how these professional people are manipulating this, right? That would be the ideal place to short, but you've got to sit there and wait for it. What happens if you short it here and you... No, funny, well, I mean, the computer has got a signal there, but would it have appeared on that bar? Or would I have to wait for this? But that's definitely that's definitely a candidate for being short, look. But you can see how dangerous it is. They have this limit up, limit down rule, which is, it sounds on paper as if it's for your benefit, but it isn't. It's for their benefit. Because those sort of rules can lock you into position. You can't get in or out. So you've got to be very, very careful. I mean, there's no logical reason, lean hogs or no lean hogs, why it should gap up from there to there. That's professional skullduggery without any question. They're whipsawing the market something terrible. But they'll do that when it's weak. So we know as soon as you see that, that market's going to come off eventually. But you can see how dangerous it is.
Right, for Julius, let's try, hang on, Tom. TOL, T-O-L, which is a US stock for, so this is just the longer picture, Tom.
TOL, T-O-L. T-O-L. For Julian, right. Well, the reason it went up there is because, look, we have a springboard, come shake out, come test, look. And there's actually testing that volume there, look. And that's why it's gone up like that. So the trending system works, look, up, 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 up. But this is a serious sign of weakness. Here. Yes, well, the computer thinks it's buying climax. But I'm not sure if it's a real, it looks like a buying climax, I must admit. But what you've got to ask yourself is, has it gone up enough? You see, obviously, the professional money were accumulating here, look. And they've obviously been buying here, and this is why they've had this springboard come shakeout. And this is why the market was tested here, look. These red down bars are tests. And then when they start marking up, look, they make sure that the close is higher than the close of the previous bar. Now here, this is probably, well, this is supply, look, definitely has come hit this. So I would say at the best, this is only going to go sideways along here. It's too early. They wouldn't give them a chance to short enough stock. And they would have bought down here, especially with this shakeout look. Very high volume, so it means that they just have to hold the market up. The daily chart looks like it's trying to go up anyway. So you have to be very, very careful here. but you would expect this particular stock to whipsaw sideways for a bit on this very high volume.
Okay, this is the euro 1 hour chart for Louis.
One hour is it of the euro? Well, let's just have a quick look back here. Wow. Load of whip. There's a shakeout. Look. Whipsawing the market, something like very bad here. On that, then the professional money gradually gets hold of it, look. And you can see the trending system is slowly trying to trend up. Allow for one down bar up, one down bar up, up. Then, of course, the high volumes coming in here, and this is what brought this signal up. Supply. Markets don't like this ultra high volume on these up bars, and that's why these following bars are more or less on no demand, and that could easily be some sort of up thrust. Supply. So supply is hitting this euro. You would expect that euro to more or less go sideways, because it does appear as if they've been buying on the low here after some effort, but we know it's hitting supply here, and if they are distributing, then they will hold the market up, and they'll probably have an up thrust or certainly some no demand up move to confirm the weakness. But I'm saying that if you suddenly see a test, you do nothing until you see a principle you understand. If you just dive in there hoping or think you've seen weakness, oh, I'm going to short this, then you're probably going to get caught, because they know how the general public think. They know how to catch stops and all the rest of it. You have to have a cause, what they call a cause, to create a move. Now, there's definitely supply there. Now, if there's supply present, the only way they can now take that up is if they have a test and if supply has disappeared. Then you expect higher prices. But we haven't seen that at the moment. And if they're distributing, and then if that is serious, genuine weakness that we're looking at there, then they're more likely to have an up thrust to catch stops, mislead you, as many people as possible, before it actually falls. So you have to keep all this in the back of your mind. And you do nothing unless you see something you fully understand. Then you're going to make money.
I'm just going to try, David, to put SPY 1 hour chart up. Doesn't look very hopeful, does it? Tom said black hole. No, we can't. Sorry, we haven't got data for that. What about daily peak? We do. We'll put the daily up. We may have that. That's SPY. That's SPY. It's the ETF of the S&P 500, Tom.
Yes, it's well, the fund that tracks the S&P, is it? Well, first of all, you could draw a trend line between there, and there. This is how Wyckoff first recommended trend line. First two lows, look, there. Make sure they're down bars. First highs here, look. Of course, we have a slight argument with what the computer wants. There you are. Well, it's obviously going up, look. But it is tracking. Look how it tracks the S&P 500. There's a gap up there. It's now overbought. There's a signal on the S&P there as well. Weakness has appeared. We're overbought. There's the test that we were talking about. And the test is a test. It's down narrow spread, look. Volume is low. That's why it's gone up there. So that's interesting, look. It's tracking the actual cash market, look. And you can see how trend lines work. They're a terrific guide. And you can see how the simple trading system works. From this side of strength here, strength coming in, that's confirmation. Up, there's your first layer for one down bar. Up, bit of no demand. They're frightened to test it at these levels, look, in case they lose control. Up, gapped up, we note, through the top trend line. There's a test. Up, and they're still trying to push up. That's actually an interesting chart. Okay, any questions?
Hello, Seb. Sebastian's here. Tom, in the room. Yes. Tom and Grigory's here as well. Hello, Sebastian and Grigory. DNKN. My favourite subject. Donuts, Tom. Donuts. Should we put a daily up?
They'll kill you, donuts.
Tom says they'll kill you, donuts. Too many of them, Will. This is Dunkin' Donuts, Tom. For Pete. I'll just put this up now. Are you right?
Yeah, well, at first glance at that chart, obviously the market has fallen, so it becomes vulnerable to professional money, one or more groups thinking they can do something with this, and that's the time when they will enter the market. So we look back here, and there appears to be a little bit of stopping volume here, look. Right, we expect a test of that.
Test after shakeouts.
Yeah, well, they tested this, look, but there is too much supply here. That volume is too high for a test. For that to go up in the bullish move, that volume has to be lower, a lot lower than that. Because this represents supply, and then when they test, it's the level that they're after. If the volume's low, then it means that the supply that was present here has now disappeared. And because the market moves on supply and demand, it'll go up. It did go up a little bit, but that looks as if it's trying to go up eventually. Looks as if they've been buying here. We don't see donuts in England as they do in America, and they I remember seeing my first donuts. They're incredible when you haven't seen one before. Big round things with icing all over them. Very delicious, I must admit. So that really, to me, looks more bullish than bearish. But I doubt if it's ready to go up right now.
Hello to TP. Yelp. TP is asking for us to look at Yelp. We'll see if we've got the data for it because we're not sure. Oh yeah, is that about right? There's a nice test there. Okay, so he's saying, can you look at Yelp with a wide spread up bar on increasing volume? And now today we have what looks like, Tom, we have what looks like a pullback test on low volume. Does that look correct? Well, this is the daily because I don't think we haven't got any other time frame, I'm afraid.
Yeah, well, that looks a bit bullish, doesn't it? Because this looks, well, it is. They've obviously been buying here, look. Right, you've got these springboards, come shakeouts, look. Loads of signals there. Up it goes. Yeah, up it goes. There's the trending system. Up, up. Now, to get up through these highs, if they're bullish, which it looks as if they are, they need a wide spread up on not excessive volume, right? But then you need a test of that. You need a down bar on low volume. Then that's going to go further higher. Okay. But they're definitely buying here, look. I know it's easy in hindsight. There you are. But at least in hindsight, we know they were buying. Look, there's even a nice test there, look.
Sebastian's made a comment on this chart.
Yeah, what's he say?
Shall I read it out?
Yeah.
Yes, so Sebastian says there is an old resistance level around the 21st of April. That's here, Tom. So we've got an old resistance level here. The market, it looks as if the market is strong. It will have to absorb any selling around that level. Is that, yep, Tom is saying yes.
Okay. You're dead right, Sebastian. That's Sebastian putting in messages. He's a very skilled trader. He lives in Jersey, tax-free haven there. He disappears for months on end, but he's very good at all this. And Gregory, who's a programmer in Russia, how are you? All the best. Hope things are going well with you. You're always welcome to come over here if you want.
Gregory says hello.
Good.
It's perfect, he says. Good to hear that all is perfect, Gregory. Okay, Robert wants to look at Canadian dollar. hourly and 20 minutes. So 6C. We'll go for the hour first. So this is the crikey. This is the Canadian dollar 1 hour chart. Must have been something going on with the news or something.
Well, yeah, we don't follow the news as such, but there's obviously some horrific news here. But what's interesting, look, we've got a signal right up thrust. There'd be weakness all through here. I mean, we could do a close study of that, and you'll find that there are more weak bars than strong. There must be. But there's probably some sort of news here. This looks like an attempt at a shakeout. Now, it's not stopping volume. It's literally a shakeout. How do we know that? Well, we assume it is because you've got this horrendous down move, but it's closed in the middle, look. And the volume is very, very high. And there's a test, look. This could easily be a bullish shakeout. That's not stopping, well, it's not what we technically call a stopping volume, because the market hasn't fallen enough to attract professional money in. They're up here, they're in the market here somewhere, right? And this is a shakeout. And you tell me these markets are not manipulated. Look at that. That'd be on some sort of news of some sort that's conceived to be bad. But we know it's a shakeout because you've got this horrendous down bar, massive volume, closed the middle. And even the next bar's up, look. And here's the testing of it. That could easily be bullish. What was the other time frame?
20 min.
What's that, hourly?
That's hourly.
20 minutes. Oh, yeah. Right. So there's that shakeout. I can't get the cursor to move. Yeah, it is. There's the shakeout. Right. Which obviously looks the same as the hour chart. Now, funny enough, we've got a signal on this, look. So the computers agree with us. Yes, you got it right. It's a shakeout.
What are you saying? Is that a test that you're on now?
No.
Not a test?
Well, no. You see, when you get these shakeouts like this on this terrific high volume, right, you'd expect the market to go up somewhat, a few bars, and arc over, and then come back down to these levels where the volume was previously at. Now, if that volume is low, which it looks as if it is, that's bullish, because the shakeout has worked. The shakeout causes tremendous supply to hit the market as traders panic and whatever they're doing, right? So that means there's supply there. Now, if it goes sideways and comes back down to that level or a lower level, right, and the volume is low, that means that the supply, this represented by this high volume, has disappeared. And the market, because it moves on supply and demand, right, if there's no supply, it means it wants to go up. That's why we figured this will be a bullish indication, a shakeout. That's how I would read it.
So Sebastian is saying the closer the bar gets to the low of the shakeout bar and the lower the volume, the more bullish it is. Is that right, Tom?
Yeah, that's right.
Yes, Tom says that's correct. Okay. Right. TP's asking for DDD, US stock. Is it 3Ds? He says, is it testing today on low volume back to the accumulation range? Well, but we won't have the data for that. We've only got daily. We've only got daily data. This is DDD, Tom.
Well, I mean, we obviously hit supply weakness up here, look. Now, normally when they test, they don't gap it down like that. That gapping down is an inbuilt sign of weakness. And you may get a small up move, may even go back up into that area. But if you see this instrument go up and no demand or an up thrust here, then that would be weakness. Normally a test, well, always a test doesn't occur on a gap down bar like that, on that terrific high volume. So even if it was a test, it'd be a failed test because look at that volume. There's supply here and the markets can't move up when there's all that supply hitting it. Imagine you're a professional trader. Would you go in there knowing that there's bucket loads of supply here, look, and weakness right behind you? I don't think you'd last very long. But they have had a shakeout back here. That's a shakeout come springboard. And that's why it went up, look. Like that. But it's hit supply there, look. And that gap down is not a test. They don't gap down bars like that for testing. And especially on that volume, that's definitely not a test. That's a sign of weakness.
Okay. Gold. Either GC futures or GLD. I'll just do this a minute. This is gold, Tom.
Well, this, you glance at this, it still looks weak, doesn't it? And we've got all these, what we call up thrusts here, look. You only see up thrusts in weak markets, look. There'll be one right at the top here somewhere, look. There it is. There it is.
No demand.
Well, there's no demand. Now, admittedly, you've got a green arrow there, which I suppose looks a bit like a test to the computer. But it's a failed test because the next bar's down. But if you want to trade gold, you have to be a specialist. You have to know what to expect with this gold, because there's so many amateurs in there, or we don't call them amateurs, call them non-professionals, who seem to like trading gold. And that's why it's allowed to whipsaw around like that, all designed to put you off, lose money, catch stops. And that's not stopping volume. We've got a down bar with high volume, but it's not stopping volume because it's gap down. Gap down like that's usually a built-in sign of weakness, especially from these areas where all these up thrusts and everything. And it's not a shakeout either. Shakeouts will be on very bad news. It'll probably close near the high, and the next bar certainly won't be down like this. That, to me, looks like weakness, or continuous weakness. Gavin loves trading gold, seems to suit him. So he's the boy that you need to question closely if you're seriously interested in gold. Otherwise, I would suggest that you study gold very, very carefully and become an expert in your own right. But it will follow the principles of supply and demand. You see, I mean, we've got a green arrow here, look. But that can't possibly be a test because you've got all these upthrusts here, look. You've got all these weaknesses lurking over your head. But if you specialize in these vehicles like this, so that you almost, it's like you know what your own children are going to do. Without them telling you, you can instinctively know. And this is why you get a specialist in gold. He wouldn't dream of trading cotton or corn or something. This is his subject. This is what he'll do.
Okay, we'll look at one more chart as time's running out. SLV. Silver. Silver, Tom. For Thomas. It seems to be coming back into last summer's lows on low volume. Shall I just put up more bars, Tom? So we're coming down to this. Tom has difficulty seeing. Coming down to this level here. Can you see that? Yeah. So shall I put 20 up again?
Yeah. Well, it looks a very similar story to gold, doesn't it? I mean, you've got all these signs of weakness here, look. These are weakness, signs of weakness. Here, you've got all these type bars. That's weakness. Got weakness there. I mean, that'd be no demand. Has to be of some sort. What's that say?
Upthrust.
Upthrust, right. Oh, yes. Yeah, that's the upthrust. Yes. Okay. So you've got all that weakness there. And then when they gap it down like this, right, that is not shakeout or strength. That's weakness. That's built-in weakness. And whether you say there was support there a year or so ago, that's far too far in the distance for us. We want to know whether that's going up or down in a fairly realistic way so that we can make some money out of short trading it. When I say short time trading, right? If you're a fund manager or something like that, then obviously you need to look at the longer time frames because you'd be more interested in these instruments over a longer time. But any intelligent fund manager will specialize. Otherwise, you're going to be whipsawed around here, and you won't know whether you're coming or going. But that, to me, looks weak. But on saying that, it'll probably go up for a few bars, which is very cunning and devious, which the market seems to do automatically. But overall, I would certainly want to be too long on that.
Thomas is saying maybe the weekly. Just before we finish, we'll just try the weekly. He said that might work better. See what that looks like.
Yeah, well, that's it's a weekly, isn't it?
Yeah.
Well, the overall picture still looks much the same to me. You've got this horrific weakness up here overhanging you, right? Trying to get my...
What are you trying to do?
Move the cursor. Oh, there it is. Yeah, okay. So, to me, I mean, look at that red down bar there. There's a red down bar, look, but look at that terrific high volume. That's supply in there. And whenever we get a blue up bar, look, right, it looks more like an up thrust. Looks like a weak bar. So it's very, very similar to gold. Seems to be trending in a similar sort of way. It's a weekly chart. But you certainly, I would strongly advise you do nothing unless you can see or you're sure in your own mind that you've seen the correct principle at work. Then you're going to make money. Then once you recognize the setups, but the market is so devious and cunning, it will easily mislead you. Very easily, so be careful.
Okay, that's it for today. Thank you for coming, and we'll be back next Friday, same time, and we'll be doing the newsletter this weekend on Sunday as usual. So thanks everybody. Have a great weekend and a good week too. Thank you. Bye.